on the breakout. Gold's going to make a new all-time highs.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin.
Hi, welcome to this week's episode of Live from the Vault. My name is Shane Morand. I'll be your host today. And just before we go to Andy Maguire for the gold and silver update I know you're all looking for, make sure you hit that like button and hit the bell if you want to be notified every time a new episode is uploaded so you don't miss a thing. Andy has done some amazing research and he's going to be sharing with us information that you just can't get anywhere else except for right here on Live from the Vault. So hope you enjoy it. Over to you, Andy in the UK.
Yeah, totally. And it always fires me up, Shane, to hear you so passionate about things. So yeah, looking forward to our chat.
Well, there's a lot going on. There's a lot going on, and it just seems to me, and I'm getting a lot of emails and I'm getting chats from people, but it's kind of a similar thing over the last couple months. Andy, every time you and I get on these bi-weekly calls, we look at this, let's call it a counterintuitive price action. Would that be fair between, you know, the strong gold and silver premiums and the price action? Can you maybe just start off the call here by telling us what you're seeing right now in the markets?
Yeah, that's a great place to start, Shane. Looking at this is counterintuitive price action in the metals, which it has continued from our last episode 2 weeks ago. And so really, let's look at what we should now expect into the year end in gold and silver, and of course, beyond. So it's really interesting. Last week's a liquid holiday market conditions. Now, if you remember, that was a holiday week last week. And really, markets shouldn't really be doing an awful lot. Most traders are not on their desks. It's skeleton crews, certainly in America. And most people are at the Hamptons. And, you know, like you generally expect prices to stay, the market to close pretty close to where it opens. And that's usually the week we would expect. But into these illiquid conditions, something pretty notable was revealed, and some really interesting footprints, especially on Friday, the day after the Thanksgiving holiday, where it became very clear that insiders were on the attack as the New York pit opened into vapor-thin US market conditions. Now, obviously, if a legitimate seller was trying to get the best price to sell something, you know, whether it's stocks, bonds, gold, silver, or anything, into a liquid holiday-driven marketplace with no news events, it's not the time or place to do it. Now, given the otherwise bullish crosses related to gold and silver, all the fundamental drivers, the foreign exchange crosses, the bond prices, the dollar week, really, this should have been if anything, bullish for gold. So really, these footprints became very clear. Now, what triggered this thin market defensive move focuses on what we discussed last time, namely, the House was under attack for their fractionally held physical bullion stocks from some very large trading houses being rationed for physical bullion supply at current paper-driven low prices. Now, the lower the paper price goes, below otherwise very bullish for gold and silver fundamentals, the less willing a real physical seller becomes to offer any bullion for sale. It stands to reason. Now, when it is offered, it's at a substantial premium to the paper price. And I know you were talking about silver last time. You were saying, oh, look at the premiums that these other people are charging. Obviously, Kinesis is a much tighter spread, but we're looking at enormous premiums for gold and silver based above the paper price. Now, it's not rocket science. Every single first-tier bank, central bank, and sovereign entity and liquidity provider that we speak to is pricing gold at a minimum of $2,300 into telegraphed massive stimulus packages which are coming down the pike. Look, it doesn't matter who is president. These banks are buying bullion below this level. They're not selling it. So this is the key thing.
So Andrew, from what you're saying, this actually sounds again positive for the price of gold, and like I said earlier, it's almost counterintuitive, because from what we're seeing and from what you're sharing, it really sounds like this price should be going in the total opposite direction from what we've seen last week. But is this positive for gold and silver?
Yeah, Shane, it's more of a focus on all the unbacked fiat currencies valued against all hard assets, really. And I mean, really, all hard assets are going to devalue. In other words, it's depreciating. These fiat currencies are devaluing against these hard assets. Now, this includes the worst of a bad lot, which is the dollar. While on the other hand, physical gold is valued by the Bank of International Settlements as a first tier asset, and really, so will ultimately lead the pack higher. Now, gold is the primary benchmark that faces all fiat currencies. And it's got to be remembered that paper gold's not a first tier asset. Only fully allocated physical gold that has no counterparty risk attached qualifies. Now, Basel III rules coming into effect in March will eliminate any valuation haircuts. Now, this is important. We'll probably look at that in a minute, but so what we're talking about is this counterintuitive action that we're discussing. It moves in paper gold. These moves in paper gold, there are just very few sellers of real physical gold and silver. Now, as wholesalers, we just see what contractually had to come to market, such as producers fulfilling normal run-of-the-course business contracts. And what we saw into this last kick at the can, paper market-driven, what we call a wash and rinse cycle, was exactly that, a wash and rinse of speculative, highly margined paper positions, not physical. Now, last week's pricing had absolutely nothing to do with supply and demand of physical bullion. Now, this is the last chapter of the paper to physical battle, which accelerated after March 23rd of this year. If you remember, we discussed this in much more detail in prior webinars, even last time. And it's an attempt for the insiders to repair trust in the casino. Now, the House, if you remember, scrambled together a band-aid solution which involved importing physical bullion into the casino to back fractionally held casino chips that are supposed to represent gold and silver. But by doing so, they put themselves in the global market crosshairs as a source for cheap bullion. And that revealed the COMEX Achilles heel. And we did talk about that last time. Now, the resulting algorithm-driven, momentum-driven overshoot of the very large competing central bank and sovereign spot market buyers we'd identified in our last episode enabled the House to lock in cheap unallocated gold credits. And we call them gold credits because there's nothing to do with physical here. And it really, we've discussed spot indexing unallocated gold in the past into a discounted price. This is pretty much what they were doing. But they subsequently intend to convert these gold credits into physical gold, but at a premium to the spot gold price. Now, so what we're saying is this defensive move comes at a price for the House. Now, by unleashing this self-feeding paper market sell-side machines, because it's gold and silver, insiders were indeed they were able to fill their boots with long positions against sucked-in, automated, momentum-driven selling by these machines. Now, this aggressive sell-side program was triggered on by the first of 3 distinct pit open sell programs commencing on the 9th of November. However, following a massive overshoot of physical buy interest levels, this paper to physical battle has finally come to a head, and a washed out paper market must be allowed to rally back. The piper has to be paid in physical or be offered a very large premium not to take delivery. And this is what this is revolving around. Now, the target last week was to discount the Bank of International Settlements options mark-to-market gold fix event on Monday. Remember, we talked about this was upcoming. Now, in fact, this marked the lowest gold fix since June, and it enabled the house to scoop much needed, heavily discounted GLD, the ETF of gold, the ETF of silver. There's two ETFs of gold and one of silver. And what they did was enable them to scoop up as much of this credit, gold and silver credit, to help to offset massive overhanging November delivery obligations, especially in gold. Now, these deliveries had to be physically delivered this Monday. That's just come past. But through this overdone move, also went some way to hedging some of the very large underwater December delivery obligations. Now, what this has done, though, it's dug an even deeper hole as gold is priced $500 below what is generally regarded as fair value, and it has been in massive accumulation by competing central banks and sovereign buyers. Now, we look at it as of today's Wednesday, 69 tons of ETF gold credits were realized over the last 4 weeks. But these are paper credits, which still must find a willing seller to fill these spot index positions. The only question is at how much of a premium to spot. Now, from what we see, substantial premiums have to be paid for large side orders for immediate delivery. Now, unless the house allows the price of paper gold and silver to rise, these COMEX delivery demands did not and will not go away, no matter how much the cartel attempts to shake them out. Now, we personally know which European trading desk was standing for large size November deliveries, most of which was locked in at a $3 to $5 discount to the spot price. Now, out of it was 34.7 tons of November deliveries came through. We know that Barclays took 17.4 tons, but we had a known client taking the last 4.7 tons on Friday. Now, all of this 34.7 tons of November delivery requests had to be physically delivered on Monday. Now, unfortunately for the cartel, these deliveries follow an unprecedented 108 tons sought for delivery in the October contract, which is also usually a very sleepy contract. Now, this is what the foot stamping is all about, seeking to trigger another outflow of the GLD gold credits, i.e. getting people to puke up their GLD positions because they see the price going down, they just want to get out. So what that does is create gold credits for the banks who forced this price lower. And really, and we say this happened into the most illiquid trading day of the year. So that really tells us an awful lot. The most obvious factor was, of course, this illiquid condition on Friday, accompanied by aggressive pit selling into holiday market conditions. But this showed a weak hand, which was far too obvious. And there's two perspectives I have on this. We've discussed backwardations in previous episodes, but this is, if you remember, when the futures price is below the real cash price. And this should not occur in a healthy marketplace, as there is a reason these differences are not willingly arbitraged away. No one wants to incur counterparty risk is the real reason. That was part of what blew up on March the 23rd. So the first perspective is these consistent deep backwardations in both gold and silver futures cannot be ignored. And given the unarbitraged duration of these backwardations added to a tidal wave of fresh delivery demands, it illustrates insiders were struggling to obtain sufficient unallocated gold credits to bridge the allocated to unallocated divide. Now, robbing Peter to pay Paul has come at a cost to them, and they just deferred. All they've done is deferred and deepened the problem. Now, caught out by this mismatch, house insiders had to focus on obtaining these gold credits from the only source available. This is the gold and silver ETFs that we're talking about. COMEX was never designed to be a physical delivery market, and it was not anticipated that close to 35 tons of November futures would be demanded for delivery. Now, this unexpected outside demand caused underpinning physical markets to flow out and has created a massive working stock imbalance for market makers still banking on shuffling warrants around a static, fractionally held bullion stock. Now, the second perspective, in order to get the managed money, that's the hot money, which was invested long in this gold ETF and the iShares ETF, which is the same thing, which is obviously a second gold ETF. In order to get them to capitulate into the insider hands, they had to allow a very profitable house-held put strike. And if you remember, we talked about puts last time, and you really need to look, if you don't know what they are, you need to look back at the prior webinar. But they had to allow a very profitable for the house put strike at $1,850 to close in the money to their detriment. Now, a couple of weeks ago, we identified the machine-driven overrun of the insider's comfort levels, identifying an options put structure that needed to be protected at 1850. Now, the house objective was to stop high-value puts they had sold from finishing in the money, allowing them to keep the premiums and to lock in a profit against put buyers when they expired worthless. Now, this is the game the house rarely loses, and allowing the options to finish in the money was the least of their concerns and the lesser of two evils. Now, we see Friday's targeted breach of the 200-day moving average, which is really, a lot of traders will know, this is a key level. And you'll know that there's going to be sell orders below that. And there's also going to be insider buy orders at that level. But it's an area where you know that you can create an enormous amount of volatility. And so basically, that was the culmination of 2 weeks of large GLD capitulations. And it was the last kick at the can to try and rebalance this working stock we're talking about. Now, we see that as an unprecedented number. We see that when we're looking at it and talking to the desk, we see an unprecedented number of these long gold futures positions in both November and December seeking delivery. They're hedged and unshakable, as we discussed last time. So from here on, the upcoming December COMEX deliveries will not just represent the usual gold warrants to be exchanged between insiders inside the casino. This is real bullion being demanded for delivery, which will be physically shipped out of the casino. Now, December deliveries have now commenced, representing some 44 tons demanded for delivery so far. We're at Wednesday here. Now, the remaining open interest represents another 63 tons standing for delivery, of which we estimate at least 30 tons more will flow out into the last delivery date for December, and that's actually New Year's Eve. Now, to provide context, notwithstanding tight global supply at current levels, just looking at price alone, any large order size of gold for 100,000 ounces of gold or in excess of the daily fix of an average of around 3 tons of physical, this physical price has to be buy settled off the exchange at far higher premiums to spot than when small lots are exchanged. So in contrast though, COMEX contracts are deliverable at face value, and as we estimated last time, plus perhaps 80 cents of handling fees plus transportation. So this puts COMEX in the crosshairs for delivery when sufficiently backwardated, a condition we have witnessed into the tidal wave of unfactored November deliveries. So, however, as evidenced by the unprecedented large-sized November deliveries due on Monday, despite all the foot stamping, the underwater delivery obligations were unable to be shaken out. We see a good deal of the GLD outflows as only offsetting a very small percentage of deeply underwater gold credits. But as we've cautioned many times, GLD inflows and outflows, they don't represent physical bullion priced in the real world. GLD outflows represent unallocated credit fixed at a spot price. But when looking to convert this spot gold position into real physical, the insider credit holder must still find a willing seller to accept a price for a larger size of physical. And as we just discussed, order size for physical of 100,000 ounces. In fact, it's a hell of a lot less right now with the Swiss refiners on skeleton staff. So, but even in a normal situation, any order size of that size have been settled well above spot. And however, in tight ration physical conditions, we see this as very much higher than spot. December deliveries currently represent little more than gold credits, is the point we're trying to make. But they can be spun out until New Year's Eve, but November warrants run through the GLD to obtain this unallocated credit have to be physically delivered at the gained COMEX price. So on Friday, we told clients of offers being made, and this is on Friday, of prices $40 above the spot price for large size to try and stem these COMEX outflows. Now, interestingly, gold has risen some $56 since then and has certainly averaged more than the $40. And we have our ear to the ground on this, and perhaps we'll have more on this next time. But whichever way you look at this current situation, unallocated contracts constitute little more than gold foreign exchange credits. And gold foreign exchange credits are essentially another currency cross, another fiat currency cross. So, but looking at silver, into the machine-driven selling, the silver futures, March silver futures, was lagging GC in vapor thin real conditions. It's a very, very much thinner market. It's easy to mess with. However, what is notable is that when accounting for forward costs, etc., into the sell-off, when we got below $23, March futures became technically backwardated by a huge 4 cents per ounce to spot. Now, that tells us an awful lot. It's 100% certain that insiders are filling their boots and will take delivery of COMEX silver. The upside profits in silver are off the scale for a March contract. In fact, looking at the option structure, the house will need to recover 25 silver very quickly to stem backwardations, and that puts SI in the crosshairs for even larger size delivery. And the SLV, which is this silver ETF, also, remember this, it represents nothing but unallocated credit, not a physically delivered price.
Well, Andrew, from what I'm hearing, these terms, machine-driven selling, you've got ETFs, you've got this paper push down, let's call it a paper push down, versus physical. And that's what I love about Kinesis. When we're talking about physical, and it seems to me that there's, would it be a battle or a war shaping up between the paper and the actual physical gold and silver? So from what you're seeing, maybe you can highlight for our community here what's happening out there, again, with this battle or this war that's escalating, and where does this go? Where do we go from here?
Yeah, Shane, it is escalating. But clearly, look, rigging a paper price lower into a deeply undervalued tight physical market when it is deliverable and you have the stock is not a sustainable strategy. I'm talking about the casino here. This is now obvious. Prices will have to rise and a fresh containment strategy has to be attempted. However, we're going to go through this, but it's going to fail. But this is where it gets interesting. Now, the CME, which is the self-regulated organization that runs the COMEX, and the LBMA, unallocated fractional gold cartel, they joined together out of necessity in March when the paper market broke. It's under attack, and this has never happened before. Now, cornered, and the physical market starting to deallocate paper gold into allocated gold, and to increasingly trade this gold off the LBMA and CME exchanges, the LBMA has stepped up the ante by trying to ring fence the paper market game. As I say, this is going to backfire. Us as wholesalers, as the people we've talked to in the know, wholesalers give this 3 to 6 months at a maximum. This is really interesting. And we've discussed multiple attempts by the CME and the LBMA to ring fence the over-the-counter directly related COMEX markets. since they came under attack for physical deliveries after the paper market fractured in March. Now, we looked at how, out of necessity, these competitors joined force directly after the exchange for physical blow-up. Now, we looked in detail at this in prior commentaries, but essentially, the EFP conduit is little more than a transfer of unallocated credit positions between the COMEX and the 10 times larger over-the-counter foreign exchange market. And it is this key unallocated credit anchor that has supported the paper game. It's become irreversibly fractured. And as we've just been discussing, this was not what was envisaged. Now, what we're currently evidencing is a competitive attack on this. The CME, on the CME LBMA, let's call it a shotgun marriage by this attack is now coming against them by some very large global players. And the COMEX LBMA Achilles heel was exposed after they scrambled to add this physical into the CME vaults following this EFP blow up. Now, this also necessitated opening up the delivery of what they call another contract called the 4GC contract, where the bullion is vaulted although it's tradable in the US under the COMEX, it's vaulted in loco London. Since then, with physical pricing being increasingly settled above spot, both of these physical gold credit pools have been under attack. And so basically, they become targets essentially for competitors seeking to fill physical orders at a discount into an otherwise tight physical market. And as we discussed last time, it's not just price that makes the COMEX attractive. It's that this pool of physical bullion is the only immediately deliverable source to fill large-size physical bullion orders without having to pay massive premiums. Now, to maintain a rapidly eroding paper gold market, 3 weeks ago, the LBMA cartel stepped up its efforts to ring-fence the physical side of this directly linked unallocated gold-settled gold credit market. Now, Reuters ran with an article on this last week, and it's as did Bloomberg, but the Reuters article pretty much lays out what this plan is. That also identified the letter that was sent out, and also we've seen this letter from our contacts in the UAE. A letter was sent out to all the major global gold hubs, refineries from China, Hong Kong, India, Japan, Russia, Singapore, South Africa, Switzerland, Turkey, UAE, the United Kingdom, the United States, demanding, the nerve of it, demanding compliance to their rules or have their refineries cut off from being loco London tradable. The nerve of this. However, this aggressive move to ring fence this 15 trillion a year gold credit trade has come about precisely due to their fractionally held working stock being targeted for physical delivery. So it's the best form of defense, attack. Now, the LBMA CME joint effort is an attempt to halt the erosion of the monopolistic hold over the global physical markets. This is being attempted under the guise of establishing a globally accepted standard under their control, though. However, this so-called standard comes from an organization that has harbored proven bad actors and worse, as just evidenced this week, trying to defend a non-physical marketplace that in no way represents a true supply-demand price. So the current price discovery mechanisms are not representative of what the industry wants. That's all the way from producer to end user. A stable, fair price based upon real supply and demand fundamentals is what is needed. This is especially important as we head into the Bank of International Settlements Basel III rules coming into force next March. That's only 3 months away, and is undoubtedly another factor in the cartel's attempt to maintain unnatural volatility into an asset that really should be traded like any other cash instrument, such as government bonds. However, this aggressive attempt to ring fence the cartel's game is backfiring. And based upon the reaction this week from meetings we've had and heard about with industry insiders, this move has accelerated the path to the cartel's demise as price setters. The fallout amongst industry titans such as Russia, China, and the UAE has wide implications for the LBMA and the COMEX. The house is actually reliant on operating within a fractionally held working stock environment, where physical deliveries represent little more than electronically matched, deallocated gold and silver positions settled by netting out gold credits amongst each other. And that's how it has worked. Now, this ring-fenced activity has enabled gold and silver price discovery to be controlled by this 10 times larger unallocated over-the-counter market, which is directly related to gold futures. And it is the directly related COMEX leg of this game, held in physically deliverable form, that is under attack. In response to this strong-arm tactic, Russia, India, and the UAE, I know for certain, are already in discussion to create a globally accepted standard, an alternate globally accepted standard. I think China will also join the initiative, likely seeking probably an LME accreditation. This may actually be the perfect vehicle for the LME to progress its plans to compete with the LBMA with a physically settled, globally accepted 4/9s, non-LBMA standard bar contract. And if you recall, we raised this discussion back in September, naming Goldman Sachs and ICBC, as well as the ICE exchange, have been working on such a venture since September of last year, when the LBMA first foreshadowed its plan to usurp the refinery industry under its brand. Now, obviously, there's a lot more to this story. I'll provide more on this major event as soon as I can.
And there you have it. Thanks for joining us on this week's episode of Live from the Vault. Amazing timing, great information. Make sure you hit the like button and subscribe. And also, if you want additional information on the digital physical gold and digital physical silver, make sure, well, you know where to go. Just click the links below to get more information. Thanks a lot, and we'll see you next time on Live from the Vault.